Grab a pen and a piece of paper right now. By the end of this short video, you are going to calculate the exact amount of term insurance you actually need, down to the rupee. To get that number, we're skipping the generic 20 times your income rule of thumb. Instead, we'll use a tailored framework called the DIME formula. The D stands for debt. If you pass away, your creditors will still expect to be paid. Tally up your outstanding home loans, car loans, and personal debts. For our example, that's 40 lakhs for a house, 5 for a car, and 2 for a personal loan, giving us 47 lakhs. This is your absolute baseline liability. Covering this ensures your family isn't immediately forced to sell their home or empty their savings just to pay off your past obligations. Next is I for income replacement. We need to calculate the capital required to keep your family afloat until you would have retired. Take your annual expenses and multiply them by the number of years you have left to work. Here, that totals 1.5 crores. Notice we are using household expenses, not your gross salary. Your family doesn't need to replace the portion of your income that currently goes to your own personal upkeep or your income tax. They strictly need to replace what it costs to run the house. M stands for major future goals. These are the large one-time expenses you want to secure for your kids, like 15 lakhs for higher education and 10 lakhs for a future wedding. That puts 25 lakhs on the board. Add your debt, income replacement, and major goals together. In our example, we're looking at a raw liability burden of 2.22 crores. Staring at a massive number like this usually makes people panic. They assume they need an incredibly expensive policy to cover it all. But that calculation ignores half of your financial picture. That brings us to E, existing wealth. Instead of adding future burdens, we are now subtracting your current safety nets. Add up the liquid assets your family could actually use today. This includes your mutual fund portfolio, your PPF balance, fixed deposits, and the surrender value of any older life insurance policies. Let's say you've built up 75 lakhs so far. Pause the video right now. Plug your own numbers into the complete formula. Debt plus income plus major goals minus your existing wealth. By subtracting what you already own from what you owe, you prevent overinsurance. You buy exactly the coverage your family needs, keeping your monthly premiums as low as possible. Let's finish the math on our example. 2.22 crores in liabilities minus 75 lakhs in existing wealth leaves a gap of 1.47 crores. Since insurers sell policies in standard blocks, we simply round this up to a clean 1.5 crore cover. This tailored approach proves why doing the math works. Instead of guessing and arbitrarily picking a 1 or 2 crore plan, you know precisely what your family requires to stay afloat. Now that you have your target number, you need to buy the policy correctly. There are 3 ground rules for execution. Rule 1. Set the coverage tenure to match your working years, usually up to age 60 or 65. Ignore the sales pitch for whole life term coverage. Once you retire and your kids are independent, your financial liabilities drop, and you won't need to pay for this level of insurance. Rule 2. Be radically honest on your application. Declare every medical condition and lifestyle habit, including smoking. Lying to get a cheaper premium gives the insurer grounds to reject your family's claim later. Rule 3. Protect yourself while you're alive. Add a premium waiver rider and an accidental disability rider. If a severe accident stops you from working, these riders ensure you get a payout and your policy continues for free. Real financial security comes from strict calculation, not guessing or peer pressure. Do the math, follow the rules, and drop your final dime number in the comments below.